Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
For today's episode, we're lucky to have Justin Dyer. He's the partner and CIO of AWM Capital. It's a multifamily office specializing in wealth management for professional athletes. Today, he's going to share with us how to think about the athletic LP target market, AWM's Capital's approach to VC exposure to their clients, and takeaways from reviewing hundreds of emerging manager decks for the RAISE program. With that, I want to say thanks for joining us. This is Justin.
Pleasure. Thanks for having me. Looking forward to chatting today.
Yeah. So I always like to start off with kind of just like the origin story, because becoming an allocator, we found over these 50 plus episodes can happen in various different ways. So I want to know, Justin, your journey into financial services that eventually led you to AWM.
Yeah, in a way, maybe somewhat traditional, but also at the same time being somewhat random. I always knew I wanted to be in finance. Going back to when I was trying to pick my major, figure out what to do with my life, I knew finance was what interests me the most. Exactly which path, what area of financial services is huge, right? That was definitely yet to be determined. But I was fortunate to have a mentor midway through college who pointed me in the path of the independent financial services world. A couple of core reasons for that. One, it was and still is a very fast growing part of the marketplace, just because of the conflicts of interest that are rife in other parts of the marketplace. And that was certainly the case way back when I was getting started. But the direct alignment with clients, it kind of goes to why it was a fast-growing part of the marketplace, but just being able to work more directly with clients in a much less rigid environment was also part of the conversation. So when I got done, when I finished up with college, I did take a year off, had a great time, but I had this true north that I always knew I'd come back to, and just started looking around, and luckily was able to find a role at the ground level within a independent RIA in San Francisco at the time. And then, since then, my career, it's been all over the place within the independent financial services world. It hasn't just been, okay, you're going to come in as an analyst, you're going to stay on the investment side, learn the craft of being an allocator, the profession of being an allocator. It's certainly, like I said, kind of what I initially was most interested in, the financial side of financial services and working with clients. But I pretty quickly found out that working directly with clients is actually really interesting. It's completely different, right? You have to understand the human psychology and behavioral finance and all that type of stuff, versus just understanding the numbers and thinking about things much more black and white. And I am super, super thankful for that experience. In fact, today I still have direct client relationships and will likely always maintain that for that exact reason, making sure the decisions we're making on behalf of allocating client money actually still reflects true client interaction and the human side of it. Since those early days to today, I've been a chief compliance officer. I've been a COO. I've been a wealth manager or maintaining direct client relationships and responsibilities. And so it really has gone through almost every possible iteration within the financial services world. I started off with more of the analytical interest and desire, and here I am now as CIO and really overseeing that. And I'm pretty dang happy with how it's all turned out.
That's really cool. I love the fact that you've played many parts within this subsector of financial services. Before we get into how you got to AWM, I wanted to get your take on how have investment management, RIA, how has that world changed since you've entered it? Because from afar, it seems like it's changed a lot.
I mean, it has, is the short answer. But to answer your question specifically, I mean, some of the more interesting changes, both you could say positive and negative. I mean, on the positive side, it's still continuing to grow. I don't think it's growing as fast as it was. This is 15, 20 years ago now. But it is still growing, and I believe that it should continue to grow because it is part of the marketplace that provides such phenomenal advice to clients. And most importantly, unencumbered advice, right? As conflict-free as you can possibly get. The whole idea of the fiduciary mindset is there and real. So I think that aspect is continuing, and I expect to continue quite a bit. On the flip side, and even kind of related, there's a lot of institutionalization of this part of the market, both institutionalization that in the sense that there are larger, much larger platforms, pools of capital, firms within this space that are impressive organizations, and that's good to see because that's evidence of maturation, et cetera. But related to that, on the flip side comment is there's a lot of private equity money coming into this as well. And again, it's evidence of maturity and somewhat of a validation. And I'm curious, still being relatively young, but experienced, have plenty of experience kind of in this nice little sweet spot, what that's going to do, right? When you change the business model and the business structure, there are potential implications, right? Are you still able to do what's truly in the client's best interest when you have a more short-term capital partner at the table with you? These are all interesting questions and interesting dynamics that I don't think we know what the outcome looks like quite yet.
Yeah, I mean, it's been one thing I've been thinking about is with the institutionalization of RIAs through kind of the private equity dollars, should we as the collective emerging manager, collective GPs, think that this is going to be committed dollars like we think of pension plans and fund of funds that are directly focused on private assets, venture capital? Or should we think of it as a point in time? Like, what do you think?
Oh gosh, I'm going to hedge and say probably a little bit of both. But what I mean by that is, I mean, I think, right, with the institutionalization or professionalization of the RIA world, should come more committed capital. I think it's only natural. There's also a desire and demand from the end client to allocate more to just private markets more broadly. At the same point, I think a lot of, let's call it generally speaking, retail investors can be somewhat fickle. Everyone wants access to private markets right now. Well, when you start to see returns, if they don't necessarily meet what's expected, even though this is a very long-term asset class, you have to be patient, you have to be committed, et cetera, et cetera. It can pull back out probably just as fast as it's gone back in. I mean, that's nothing to say about the various regulatory restrictions and whatnot, which obviously kind of a moving target, or certainly there's conversation around breaking down some of those guardrails for better or worse, quite honestly. But I do think there's going to be, if I would put it into a summary, I do think there's going to be more capital going into private markets. I think that trend is going to continue. Is it going to be long-term committed, stable? I kind of question that. I think it probably depends on the partner, the firm, the platform, et cetera.
Okay, that's fair. I'm kind of in the same boat and how I think about it too, Justin. Now, moving on, we were in your story. How did you get to AWM?
Yeah, so my career started in the Bay Area. I worked for a couple different organizations there. While we were in the Bay Area, I had pivoted more truly back to the investment, the allocator seat within the industry. On the personal side, my wife and I, we were living in Marin at the time. We had lived in the city, Marin, had our first child, my son James, and all of our family was still in Southern California. We both grew up down here, and as we just were looking to grow our family, basically just made the hard decision to relocate down here to Southern California just to be closer to family. And then fortunately within our network and specifically some family connections here in Southern California, I got put into contact with Brandon Averill, one of our co-founders here at AWM, and Brandon and I had gotten to know each other actually prior to us moving down here, but really started to develop a relationship when we came down to Southern California and just saw extreme values alignment and extreme alignment in what they were trying to accomplish with AWM in the early years and what I really wanted in my career. And so it was kind of a no-brainer to join forces at the time.
Nice. And give us an overview of what you all do today and your focus. Your focus clientele obviously is professional athletes, but all the things that you offer.
Yeah, sure. And it's actually super, super important to us to expand it just beyond the allocation or asset allocator side of it, even though obviously that's the point of this conversation and my area of responsibility. But as you mentioned in the intro, AWM Capital, we're a multifamily office with a focus on professional athletes, and the differentiator, the strong identity that we have is around this idea of a human-centered financial services firm. What that means, much more than just kind of a soundbite, is to say, hey, money is a tool and should be thought of solely as a tool. Money is a tool to accomplish what is important to you. Figuring out what's important to you is step number one, and then orienting everything that money touches, which is quite a bit in life, to support that goal is this idea of a human-centered financial services firm. And the hope or the theory being that if we can allow money to play a supporting role as opposed to a central role in people's lives, they're going to have a lot more impact, whether that's local, whatever impact is unique to each and every individual. And as a result of having more impact and more direct purpose, you're going to live a more flourishing life, which should lead to a more flourishing community. So we really view what we do as being mission driven and allowing us to have an impact through our clients who are arguably very impactful individuals. It depends on the sport and obviously how prominent of an athlete they are, but professional athletes in general have an impact, and it's certainly a way in which we can support that.
Do you have any favorite, anecdote or story with any athletes that kind of show kind of the help that you guys have provided, or just even going on the journey?
I won't name specifics, but so we work with professional baseball players, football players, and professional golfers. We do work with non-athletes as well. But one of the coolest stories, to answer your question specifically, is I think because of that framework. So we have a client. He was a young pitcher at the time, and just I'd say, kind of simply through this general framework, right? There's some very specific and tangible items that I think led to the outcome I'm going to highlight. But this idea of a human-centered money as a tool type framework is basically what he attributed winning a Cy Young to.
Oh, wow.
Which is huge, right? It's awesome to be able to say, hey, you reach this pinnacle, this award, because of a framework and guidance that we put into place, a few years leading up to it, but it just allowed him to focus on his human capital, on his craft, and take it to the next level. So I think that example, that highlight is something pretty cool to rest our hat on.
No, that makes a ton of sense. When you're someone in his position where, assuming unless they came from significant wealth, which some athletes do too. But if you are kind of the taking care of a whole generation or more, and there's so many things in flux, having the confidence of like knowing that your finances and wealth creation is in a good space, you feel comfortable about it, it's also aligned with whatever your values are. I can see how that then helps you focus on your craft, right?
Yeah,
I
exactly.
think a lot of times people forget athletes are just like real regular people where, they're going into the office with a lot of real life things going on too, and then expected to perform and then answer questions. It would be equivalent if like after every board meeting, we had like interviews after we had to do a press conference, which maybe we should. That would be kind of cool.
That would be kind of cool. Yeah.
Ernest, you've been traded. I wanted to move to a large number of our audience is GPs, either at established firms or emerging managers. How should they think about even approaching kind of this subsegment of athletes as LPs or celebrities or this kind of these special interest groups?
Carefully, I guess is the immediate answer. No, I mean that somewhat tongue in cheek, but somewhat legitimately. And part of that is, I think you hear athlete entertainer. Well, first of all, not every single athlete and entertainer is the same, right? And there's a couple sub bullets even to that comment, right? So depends on the sport. You think about baseball. Baseball is it's challenging to engage with professional baseball players, and that's both, I think, a detriment to professional baseball players, but even I think it from a GP, even founder side, trying to engage with professional baseball players, like you just have to right size your expectations. The reason being, it's an incredibly long season, and you're playing almost every single day. And so the ability to have free time to go, do extracurricular activities, meet managers, meet founders, tweet, etc., like use your platform, it's challenging. Whereas sports like the NFL and basketball, and this is kind of why I think you see more athletes from both of those sports more engaged in the world of private markets, direct company investing, etc. It's a little bit easier. And so not all sports are created equal, I think is number one. Number two is just be very clear, either directly with the celebrity athlete entertainer on expectations, and they should be very clear back. Often I think that the expectation that these individuals can, move heaven and earth through a single tweet or will show up when they say they're going to show up, quite honestly, can just set people up for failure. So I think very, very clear expectations and lines of communication are critical. Hopefully, I'm biased, obviously, but hopefully there's an intermediary involved, and can help facilitate a lot of that conversation and accountability, etc. But the other thing as well, I'd say, is from an athlete side, for any athletes that might be listening, you need to think about this, and you can really learn from GPs if you're interested in the private markets. Just because deal flow is coming towards athletes doesn't mean you should do a bunch of direct deals. That is an incredibly difficult endeavor, and that's a conversation we talk about quite a bit. Are you thinking about portfolio construction the right way? And if you don't know what that term even means, then you're probably not, right? This is an incredibly difficult endeavor, investing in early stage companies, and you should think about it and surround yourself with the right people.
Yeah, I was going to mention that later, but since it seems like a number of athletes and entertainers now have more ideas about, an interest in the private markets and actually kind of jumping right in, right? Like, I think it's because of maybe a Shark Tank or whatever, but venture has become more mainstream. In those instances, how do you all approach when, a potential client or current client has a number of ideas and ambitions, whether it's like starting their own fund or just doing, as you mentioned, an example, have a ton of deal flow coming to them and want to do those deals?
Yes, I didn't mention at the outset that part of the ethos and really the genesis of AWM was to change the culture between athletes and money. And so to answer the question specifically, we love that actually because it ends up being an education opportunity to expose how difficult it is to do this, and really ideally get to a point where we say, hey, are you truly interested in this? Or is this just kind of a passing fad and you want to do this because we see other people doing that? And that's fine, right? Either outcome are fine. But if it is this idea where, hey, we have deal flow, I got this opportunity. Okay, let's understand what other GPs do, professional GPs do in their portfolio construction, like I talked about. Okay, if you're interested in going down this path, let's put together some sort of portfolio construction model. How many deals does that actually look like? What do you think your unique deal sourcing mechanism looks like? What can you actually commit to, both in terms of financial resources and time resources, and like really try and formalize it and professionalize it. And sometimes those are really good, or I shouldn't say they're always good conversations, but lead to really productive outcomes. And other times it's just like, oh, I understand that, let's just keep it more in this systematic fund of fund type platform that we have to offer folks, to give them that opportunity, because you can still have the exposure to founders and be able to influence people even within the fund of fund platform. That doesn't always have to be direct. So we welcome those conversations. We think they're great. It's an excellent opportunity to educate and really inform.
Yeah, I think you kind of touched on it, but I wanted to just throw up the question anyway to see if there's anything you want to expand on. But is the ethos of like the AWM's liability-driven approach to portfolio construction, is that kind of all the things that you've mentioned thus far, or is it succinctly a little something else?
No, I think it's exactly what you said. It's all those things in a way. It allows us to it's where the rubber meets the road, I guess, to use that cliche, where it allows us to take all of these frameworks that we've touched on, these concepts that we've touched on, and capture client priorities, client goals in the form of, we just call those liabilities, to use to use the liability-driven framework terminology, and are then able to build or to match those liabilities / goals / priorities with the proper asset class. You think about something as simple as just plain old reserves, okay? You match those with treasuries. I call this like Maslow's hierarchy of portfolio needs. So you start with that foundational level, and then you build from there. So it really is the culmination of everything, and allows us to get to this portfolio that is truly supporting client priorities, client life, client impact.
Now we're going to take a quick break to speak with our sponsor. On today's expert segment, we have our industry experts and sponsors, Shane Goudey. He's the leader of Sidley's venture funds practice, and Mathew Eapen, partner at Sidley focusing on investment funds and private equity. What do you see as the biggest regulatory shifts impacting venture funds today? And that seems like a loaded question, but...
Yeah. Matt, why don't you go ahead?
What is really fascinating with private capital right now is it's really on the precipice of like becoming mainstream. You're seeing more retailization. Yeah. And, as I'm getting in trouble with my capital markets peers here, but as there is like softness in cap markets and companies are staying private longer, there's really like tremendous opportunity in private capital. And being able to retail that and being able to lower the thresholds potentially for a accredited investor and qualified purchaser, and to give access to retail investors to private capital is like very interesting. And I think we're going to see over the next like 5 years just an explosion in the amount of funds raised, the amount of like different strategies. And I think that's what makes it really exciting to be a lawyer. There were some like fairly interesting private funds rules that ended up, going through the court system and not being enacted. I imagine we'll see a second iteration of that at some point, and it might be a watered down version. But yeah, I think the retailization, and it's something that people are aware of, but I think it sort of gets lost in the background, and I think that's going to be tremendous momentum for the industry as a whole.
Yeah, I think that's right. I think that, what I have seen is just the relative level of interest in venture capital from non-traditional sources. And I think that a lot of it is largely attributable to who are becoming venture capitalists these days. And whether it's, mainstream people like Snoop or, you name it, there are a lot of people who are attracting relative interest from people who have historically never heard of venture capital or had any interest in even thinking about personal investments in this way. Now seeing and understanding that these people, I don't know if say emulate, but certainly are exposed to and have the ability to open up, whether it's the intersection of entertainment and venture capital or social media and venture capital. I just think that not only is it the relative access to much more deep pockets in terms of the audience in which is going to be available to invest, which is very much the retailization piece that Matt talks about, but I just think it's just the relative level of interest, and that's the managers themselves, and seeing the success stories of people who, haven't been at Excel or Benchmark or Redpoint or Lux or, you name your blue-blooded venture capital firm. These are really people who are the emerging managers are seen get into deals and be tremendously successful. And how exciting is that? Opening it up, and it's people not only just white males, it's it's diverse fund managers, and seeing the relative level of excitement for it all. Now it's challenging and it's difficult, and fundraising is brutally difficult, but having more diversified approach and perspective in the venture bloodstream has been a damn exciting thing to see, no doubt.
Yeah, and I think to that point, even seeing not only the new entrants or kind of non-traditional, but seeing those folks team up with a lot of people who are spinning out of the bigger funds, I think we're going to see some exciting things over the next 15, 20 years. But I think, one reason many people, well, first of all, you need to have counsel, especially if you want to get institutional capital. But one of the main reasons is also thinking about all the compliance and risk mitigation. Are there any kind of topics that come to mind for you all for 2025 and 2026 that fund managers should be acutely aware of?
Yeah, I think it's, I don't know if there's any newness to any of it at all, but I think that there will be, as newer entrants come into the marketplace, it's just the protectiveness of the SEC and other regulators with respect to ensuring that these individuals understand the difficult decisions and the relative decision markers it makes to invest in a fund, or if they're going to invest in companies directly through other platforms, to be able to do that. So I would say that whether it's retailization or not, I would say that the underlying key regulatory ethos, I guess, opening up the markets, to be sure. I think just the current administration will be very much in that mode. Opening it up to less regulation in certain areas, maybe cryptocurrency is a perfect example of that. but nonetheless that the investor themselves is going to be somebody who's going to be protected. So I think access and protection are certainly going to be two interesting avenues to see how they ferret themselves out. I don't think we know that quite yet, whether it's a lessening of a standard on accredited investor or broadening, who might be eligible to be treated for securities regulations, legality of an investment in a venture fund. But nonetheless, I think it's important to have that be understood. But what I will say is that if we look at these private fund advisor rules that Matt mentioned, or the Corporate Transparency Act back and forth, Circus Act that's gone on recently, there are pushes and pulls all over the place on the right answer for how to deal with any of this. And our heads spin often as lawyers trying to advise clients when the law is changing, almost on a daily basis. But nonetheless, I think it's more just understanding and having a deep knowledge of what's active, what sticks of dynamite have been lit, and who's likely to get to the fuses before anything blows up. But if there's a very short fuse and you need to know about it, you've got to have partners who know kind of what to look out for. I don't know, Matt, what are your thoughts?
Yeah, as the fundraising timelines are longer, what we're really seeing is like just very complex side letters and very complex contractual arrangements where, like you will spend weeks, months getting, these very, very long agreements, and then closing happens, and, like you sort of like explain to your client all the obligations, and then everyone pauses and you wonder 5 years from now if anyone's going to remember what was in here. And so like, I think in that compliance aspect, because the relationships are very complex now, it's incumbent on GPs to remember sort of like what they've agreed to and what they need to abide by and things like that. And so those are where I think really sophisticated counsel that you view as a partner, like that communication says like, hey, did we ever agree to something like this? And it's like, yep, 3 years ago, here's the side letter, like that is really important. And the other is just like open communication. If you're thinking about, as a manager, you're thinking about asking a question, just ask it. Like worst case scenario, everything is covered, but there's so many times where, people will hesitate to ask about something because they don't, they're either afraid or they don't want to incur a large legal expense. And there's so many times where just like approaching an issue early from a compliance perspective is just worth sort of exponential returns before it turns into a bigger problem.
And then there's so many, this is kind of driven by the fundraising period, but DPI, right? And trying to find through secondaries. And then we also have, all these continuation funds that who knows if people will raise other ones, and GP-led restructuring. And then I'm not even mentioning probably the emergence of more zombie funds.
And now back to our LP interview.
I wanted to shift gears and talk about AWM's venture capital strategy versus kind of other RIAs. We talked about it earlier in this conversation, but we're seeing a lot of roll-ups plus outsourced CIOs. Do you think there's any limitations to that? Or do you think, the approach that you guys have had is like hiring you and having you as the CIO and having that expertise of venture? Do you think that's needed as well?
Well, of course, I'm going to say yes, but I'll give you hopefully a very strong rationale to that. I think those other solutions are not bad, right? But my hunch, my best guess is that you're going to get average returns in a solution like that, especially as more and more capital goes to the private markets, right? The cost of capital is going down in the private markets, broadly speaking, certainly in venture. And that has ramifications to expected returns long term. Again, we're talking macro on average across the entire asset class. And these platforms have so much capital and need to allocate to certain fund types, and the ability to deploy those large amounts of capital dictate larger funds usually. And so you put all this together, I just think the expected return is going to be less, all things being equal, using those platforms. And so that logic is essentially why we've set our venture platform up the way we have in focusing on smaller funds, the emerging manager space, not exclusively, but certainly having an emphasis or tilt to that. That's supported, I think, broadly by the data, where there's higher likelihood of outperformance there. Certainly, there's a lot more distributions. I'm not ignorant of all that, but if we can craft a portfolio of committed managers that have certain criteria, et cetera, that fit these smaller buckets, some of which will be emerging, some of which will be established, but have committed to smaller fund sizes, you can only do that at a certain scale. And we're fortunate to be in this, like, we're big enough to have the resources to do it, but we're also small enough to still allocate effectively in this space. We're not hundreds of billions of dollars. We're a very healthy size to get very good exposure to that part of the marketplace.
That makes sense. We just had Samir on the show from Allocate. And so I wanted to just get your take on what do you guys use Allocate for within your venture platform and kind of processes?
Yeah, so it's evolved a little bit over time. I mean, Samir's just a good friend, and what they're doing over there is great. It's cool to see the success that they've had so far. And Hannah's a great friend as well, so I can't leave her out. And so as our program or platform has evolved, I would say use them somewhat as like a completion tool where I'm a lot more, and I think the part of the market that we just talked about, smaller funds, even emerging manager, requires a substantial amount of due diligence.
Yes.
And part of our portfolio in the past, it's evolved over time, did have a little bit later stage allocation, and leveraging a platform like Samir and other partners in the past. Like we've partnered with what used to be called Next Play Capital early on in our venture allocation days, and these were all great partners, right? To pretend we could do it all is a fool's errand, So they were great partners for those purposes. And now fast forward to today, I'm super excited that on the technology side that Allocate is building to help us better maintain the pulse, the details, the data within our portfolio, because after a while you get 30 plus manager relationships, and the underlying portfolio there becomes this vast amount of data. And I think what Allocate's really trying to do on that front is awesome, and we're looking forward to helping them develop that and utilizing a lot of those tools going forward.
Could you talk to me? I mean, at some point, if you started out getting into some more later stage established funds, but now evolution to also include emerging managers and heavily tilt towards that. How did you get to that process? Because as you mentioned, Justin, it's really hard to do that, and there's a lot of due diligence required. How did you build that expertise?
The strength of the network, if I were to distill it down into one quick answer, but to unpack it a little bit more. So earlier on, when we were small, this is almost 10 years ago now, I guess you could say, we wanted to do venture where our clients had an interest in it, and but we didn't want to just say, oh, we can do this, we can figure it out ourselves. And so that's where these great partners at various phases in our history have been incredibly valuable to us, to allow us to kind of crawl before we walk, before we run. But as we got our toe wet and then understood the broader asset class, it gave us visibility into the data that I referenced earlier on, around smaller funds, around earlier part of the market, and all these different characteristics that now represent how we allocate today. It took time. It took being in the ecosystem. It took getting exposure to RIAs, where you see the dynamism there, but you also see, you know, the good. You see the good with the bad as well, I guess, is what I want to say. And it certainly gave us the exposure, gave us the confidence to create the platform that we have today, and over time allowed us to learn what actual due diligence takes and how complicated that whole process is.
What's the criteria and processes that you use when evaluating new fund opportunities?
So, not to go into the gory details, but just to give kind of a high level overview how we think about it. You know, there's just, I would call it the basic screening criteria. Does it align with our target fund size? Does it align with what type of stage exposure we want? And we'll go through our internal process to understand portfolio construction. Okay, can this fund actually accomplish what they say their goals are? You know, are they trying to 3x? Is this a fund that's swinging for the fences? How does that complement other funds within our portfolio? So it's both, I would say, almost like top down, our portfolio construction. Is this overall fund additive to what we're doing? But then bottoms up, is this a viable strategy in its own right? Is the sector focus a little too myopic for us? We do allocate to certain sector specialists, but we don't want to focus on sectors that are so narrow, in our opinion, where, you know, they have to thread that needle perfectly to get a big outcome. Whereas we like sectors that maybe, you know, are quote unquote sector specialist type funds, but the sector themselves are just these massive opportunities. You know, one of the big, and I'm sure everyone does this, but one big area of focus and honestly, area that we're always trying to prove upon is the reference check process. Because, you know, you can go through a standardized or just you know, a due diligence process, like kind of very rules based. Are we asking this question? What's the strategy? Does the fund math check out? But the reference check process can be so critical on actually highlighting the manager themselves as a human. Are they capable of building their own firm, right? If in the case of a emerging manager fund one, right, that's a completely different skill set oftentimes than just managing money or, you know, writing checks. So I think that's something we're constantly trying to get better at. Can we figure out how we can reference our network better, triangulate certain things versus just, you know, going down an LP or a GP reference list and getting some more, you know, it's helpful, but a little bit more boilerplate type referencing. So that's, you know, I probably kind of went all over the place, but that's the general due diligence process.
Okay. No, it made me think of a emerging manager friend told me that one of their LPs that committed on fund one, like heard their pitch and did like 30 reference calls and told them, you're doing everything wrong. You're doing something wrong, even though he had committed. And the insight she provided me was that the LP actually was looking for, and I never heard this, but it makes total sense, but he was looking for consistency of like what the emerging managers were pitching. And was that aligned with what they were hearing from founders, other LPs that they pitched and everything? Because that should truly be a through line. One of the emerging managers should be extremely self-aware of like what they're good at and what other people see their value is at. And then those stories in different ways should be coming up in their references. So I thought that was such a like fascinating perspective.
I actually really love that. The one other thing I try to isolate is this idea of stewardship, of capital. Especially like it's something we take pride on ourselves and talk about a lot internally. We believe we're stewards of our client capital. I think it's incredibly important in the private markets and venture as well because of the long duration of this asset class. You're putting money to work that is going to take, in this marketplace, many years to come back. And that's, obviously that's a criteria and trait that we all need to be comfortable with. But I like having this idea of if we can figure out if someone has that identity of being a steward of capital in their process.
Absolutely. Do you have a manager selection story that you want to share?
Actually, one of the more recent, the more recent fund, and I won't name the name. Maybe some people can figure it out. And I want to highlight it because obviously there's a lot of GPs that listen to it, and it's just a great example of the length of time things can take sometimes.
Yeah.
So it was at a conference, Bridge Global. I'm sure folks know of that organization, trying to back women GPs and really grow and support that part of the marketplace, which is great. And they do this speed dating process, for lack of a better term. And I met a manager. You get pitched in I think less than 15 minutes. I think it was like 12 minutes at the time. Anyway, very long, a little laborious process. Can you do that for, I don't know, 2 or 3 hours in the afternoon? But that was my first interaction with a GP that we then committed to. I think it was 18 months, maybe even more, closer to 24 months after that initial interaction. And part of that was the length of the time was, I think I give credit to them to follow up. Part of it was me and my team's comfort just slowly understanding what they truly do and what their differentiators are. And I think it's a great example because both on our side, you don't know where opportunities are going to necessarily present themselves. But then on the GP side, it just unfortunately can take quite a long process to get that final commitment, to get that final yes.
Yeah, you're always here. Persistence is important for a GP, especially if you're starting your own firm. And yeah, you got to keep at it because after talking to so many allocators, they've told me they've been accustomed to like meeting someone great and then the person quitting or just not following up, right? Everybody has busy lives right now. And so like, it's important for you as a GP to be just like you want for your founder. If they're trying to get customers, to get revenue through the door, you need to do the same thing in kind of cultivating those relationships. But during that time, Justin, like you spoke to like getting comfortable and understanding the differentiation. What were the best ways that manager kind of helped show you that?
Yeah, that's a good question. I think a lot of it can boil down to the good old fashioned in person. Mm-hmm. That was a big, I'd say, step function. If I'm looking back on the process, it was a 15-minute in-person interaction, which was great, but they luckily are here in Southern California as well, in the LA area. And that's really what reignited the conversation. We had an in-person interaction. It was actually, I believe it was at Upfront a couple years ago.
Great place.
Yeah, great place. Yeah. And we sat down and had lunch at Upfront, and it was just this moment of really good personal connection where I think I understood them better as humans. And I was like, oh, actually, not only are you good human and you're incredibly thoughtful, but your strategy is thoughtful as well. And so I think that was if I pointed to one singular event, and then we got into the weeds and really understood everything and validated that way. But that piece of it was incredibly important.
Now, you mentioned before Raise. Could you give us an overview of Raise Global? Because I think you're probably the first person to talk about it here on the podcast.
Sure. Yeah. So Raise Global, it was co-founded by Ben Black at Acadian and Joanna Drake from Magnify, now Magnify Ventures. Joanna started it before she started Magnify, and it's a platform built to support emerging managers or expose rather emerging managers to a base of LPs that are very interested in that part of the marketplace. It has grown. It's cool to see. It's grown pretty substantially. I think it's in its 10th year. Either last year was its 10th year anniversary, or this upcoming year is, and it's grown substantially. It's very, very cool to see. I've been involved on the selection committee. I think this will be my 5th year, and that exposure, that invite, if you will, which actually came from Joanna Drake at the time. Joanna and Magnify, and I know she wouldn't mind me saying this. That was one of the very first emerging managers we committed to and to build out our platform, and that coincided with us getting exposure to the Raise platform, and then just seeing this incredible onslaught of fund deal flow, which can be a lot to go through, but it's incredibly valuable data.
Justin, any major kind of takeaways from reviewing those hundreds of emerging manager decks for Raise?
It's really hard to stand out. It really is hard to stand out. I also think this is the unfortunate reality of a popular asset class or popular marketplace. There's a lot of people who are doing this kind of more from a point of vanity. Hopefully that's changing. I think it's changing. Right? There was certainly a peak or crescendo to that in the 2020, 2021, even maybe 2022 timeframe. But that on the flip side too, I think it still is an incredibly important part of the venture ecosystem. So keep at it. Try to really truly differentiate yourself. If you're doing another $50 million fund that's focused on SaaS, you're going to have a really, really hard time doing that, or AI, whatever. You're going to have a really, really hard time doing that. I would also say don't chase trends unless you have a true differentiated thought on that or ability to allocate capital there. Because those are not ways in which you're going to build a long-lasting firm.
Yeah. It's so true. You got to differentiate yourself and really it goes back to being that thoughtful, especially when you're, submitting with hundreds and hundreds of other people. Is there any lessons that you learned from fellow judges? We saw that a former guest on the pod, Eric Sipple, was on there as a judge as well. But curious if you've learned anything from being around those other folks who have various experience as allocators.
Yeah. Yes, I know is a short answer. Is there any one specific nice little soundbite? I think it's hard for me to distill it into a nice little soundbite, but maybe I'd highlight themes more so than anything. Some of which I've already talked about. One is just in general how important the emerging part of the marketplace is. All going back to Eric Sipple and those individuals, seeing them and their commitment to this part of the market is great for me. I'm not just this lone warrior. There people have come in my path, I guess, before. So that's great. That's very, very validating. But then, it's understanding nuance. So your example around the themes that you're trying to assess in due diligence and what are true standouts when you're reviewing decks. Sometimes it isn't just a super tangible quantitative thing. Sometimes it is trying to assess some sort of theme that can highlight itself through a deck. And I think how they've set up the review process, the scoring process for Raise, so that the I think there's like 20 some odd people on the selection committee now, can all take their biases and then get it to somewhat of a consistent methodology, so it's somewhat uniform, is pretty impressive. And I think looking at how they've asked us to score certain things, it is indicative of that, and what type of categories or what type of qualifications that they've asked us to score on is really, really helpful.
Okay. Any parting thoughts for our audience, which is allocators, emerging managers, and established managers?
Sure. Keep at it. I mean, I'm gonna repeat a couple things that we've already talked about. You know, the persistence, the standout, right? Or the really make the effort to differentiate yourself. And I think the community at large is there to help people. But ask them in a respectful way, right? Don't ask them in a way that they think you're also asking to raise money. But if you're truly saying, hey, can you look at this deck for me? I'm curious what your feedback is. I'm happy to do that, time permitting. The other big item I would say is super important to us and our ethos is that, the more that people can think about money and allocating capital in this human-centered framework, so you individually can live a more fulfilled life, I think is incredibly powerful. And I could talk about that all day. We can talk about that all day. But it's super important to how we think about constructing portfolios overall, public markets, private markets, but then that's how we're allocating our end client dollars within venture as well. And it's important to me to help people think about money more holistically, as opposed to just, in your specific little silo, or our specific silo in this case of venture capital, or maybe it's real estate, maybe it's something else, but take that step back for yourself personally, and I think it can lead to some better outcomes.
No, totally agree. Having that, money be a tool for your life, and holistically, I love that approach, because a lot of times it just becomes a means to an end, not knowing also kind of the families of origin people come from that shape their view of money.
Yep.
So yeah, we can talk about that next time I'm in LA for
Awesome.
hours.
Yeah.
Justin, thank you so much for being on the podcast. And yeah, can't wait to have you on in another year or so.
Awesome. Thank you so much. I really enjoyed it, Ernest.
See you later, allocator.
After Portfolio Tile, investing with a smile.